Assalamualikum OyaRahmatullahe OyaBarakatuhu. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. Okay, we will start today a new chapter, that is risks. Already we have learned in managerial finance risks and return chapter, but here we will try to learn some advanced level. So meaning of risks, we know it, that is the uncertainty for our return. So that is a very core terms. You have to go through these materials. Elements of risks. What are the elements? Basically two elements: systematic risks and unsystematic risks. There are risks which cannot be eliminated, that is the systematic risks, and the risks which can be eliminated by making portfolio, that is unsystematic risks. So all of you have several idea. Now systematic risks in here is the interest rate risks. Interest rate risks is a type of systematic risks that particularly affects debt, that particularly affect debt securities like bonds and debentures. A bond or debentures normally has a fixed coupon rate of interest. The issuing company pays interest to the bondholders at this coupon rate. A bond is normally issued with a coupon rate which is equal to the interest rate prevailing in the market at the time of issue. Subsequent of issue, the market interest rate may be changed, but the coupon rate remains constant till maturity of that instrument. So the change in market interest rate relevant to the coupon rate of a bond causes the change in market prices. That's why there has a possibility of variability of their return. That's why it is the interest rate risks. After that, market risks. Market risks is a type of systematic risk that affects shares. Market prices of shares move up or down constantly for some time periods. A general rise in share prices is referred to as a bullish trend, whereas a general fall in share prices is referred to as a bearish trend. In other words, the share market alternates between the bullish phase and bearish phase. The alternating movements can be easily seen in the movement of the share price in the stock exchange index, Dhaka Stock Exchange or Chittagong Stock Exchange. So the price are always time moving up or down. That can be causes by the market movements. That is called the market risks. Purchasing power risks. It is also another type of risk. That means it is related to the time value of money. So today you purchase 100 taka with a 1 kilogram tomato today, but in the next year you cannot purchase this 1 kilogram tomato with this 100 taka. Then maybe you need 110 taka. So that is actually related to the purchasing power risks. Always time reducing this power day by day. So once upon a time we have heard that a cow value is 1 taka in the time of period of Ishakha. 1 mon rice 1 taka, 1 kilogram ghee 1 taka. So but now it is huge prices, so that is related to the purchasing power risks. So on systematic risks, these risks can be reduced by the making a portfolio. So here is the business risks and financial risks. So business risks, operating business risks is related to the operating environment of the company. So if you manage your company well, very efficiently, then you can reduce this business risks. And the financing pattern adopted by the company, that means if your capital structure has the more debt, then you have financial risks. So if you take less debt, your financial risk is less. So these two types can be also discussed in here. So you have to go through in your materials. So I will jump to the mathematical term. So measurement of risk, so that is the return, forecasted dividend plus forecasted end of the price of the stock price, initial investment minus 1. That is the formula for return, or simply return. So in managerial finance, you have learned CT plus PT minus PT minus 1 divided by PT minus 1. That formula and this formula is the same. Here it is using for calculating return. So here is the possible returns and possible of occurrence. So if you multiply these two things, then you can get return, and whenever you average of this return, you can get expected rate of return. Actual expected rate of return means the average rate of return. So here is the possible returns and possibility of occurrence. That means your possible 30% can be occur by the 10%. So your return should be 30%. That means if you invest 100 taka, from there you can get 30 taka, and its possibility is 10%. That means 10% possible to get that return. That's why it is called 0.10, and all probability equal to 1. So if you sum of this probability, it should be the 1. So then if you average of this value, then you can get the expected rate of return. So here is the formula, expected rate of return. So you learned already this in managerial finance. So that's why I am escaping quickly. All things are learned by you in the course of managerial finance. So here are the possible returns, probability, and if you multiply of this return, you can get the return, and whenever you sum of this return, that is the average rate of your return, that is expected rate of return. From the use of expected return, you can calculate risks, that is standard deviation. Here is the formula for variance, x I, that means return, minus expected rate of return whole square into probability, p into xi, that means probability. And whenever you root over of this, you can get the risks, standard deviation. That is the formula for variance. Here is the variance word, variance, standard deviation whole square. So this is our possible returns, probability, and deviation from this 30 minus our expected return. Our expected return here is our expected return. You have to find out at first expected return. So if you multiply these things, it may be this problem. Yes, this problem, that is our expected return is 48. Our expected return is 48. That is the 48. That is our expected return, 48. So 30 minus 48, that is the minus 18. 40 minus 48, that is minus 8. 50 minus 48, 2. 60 minus 48, 12. 70 minus 48, 22. So that is our deviation. Then now we have to whole square of our deviation, that is this portion, whole square. So whole square, that means 18 whole square 324, 8 whole square 64, 2 whole square 4, 12 whole square 144, 22 whole square 484. And then now if you multiply with this value with the probability, that means this is the portion, you have to multiply this portion with the probability, then we can get such result. And these are our variance. Summation of this is variance. And then now if you root over our variance, we can get a standard deviation. 10.77 is our standard deviation of our examples. So in the method described above, the probability distribution of possible returns for an investment proposal is used to estimate the expected return from the investment and its variability. The mean gives the expected value and the variance or standard deviation gives the variability. This widely used procedure for assessing risks is known as the mean variance approach. So after that we will try to discuss beta. So I think next class we will try to discuss that portion, beta. We will discuss it in the next class. This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.